I get asked the same question constantly. Is now a good time to buy property? And for years, I give a pretty diplomatic answer. It depends on your circumstances. But that's actually a load of rubbish. Here's what I've learned deploying capital into UK property. The perfect market doesn't exist. It never has and it never will. Every condition that helps buyers also creates a problem for buyers. It's like a yin and a yang. You can't have one without the other. But in 2026, something feels different. 2026 comes closer to the perfect market than anything in the last 15 years. And by the end of this video, you'll understand something most property investors miss. And you're probably going to want to send this to someone else as well. So let me show you. I'm Jim Holland and I deploy capital into HMO conversions in the northwest of England. Not theory, active deals. And if you're new here, subscribe for more property investing content. And in this video, I'm going to break down 5 types of property markets. And each one of them looks attractive on the surface, but each one has hidden downsides. Then I'm going to show you where 2026 sits within these markets. And this is a spoiler, the conditions are stacking up like nothing else since 2009. Every property market contains its opposite. When it's easier to buy, it's harder to profit. When it's harder to buy, the returns are often better. This is the tension most investors miss. They chase the unicorn. Cheap prices, low rates, high yield, strong growth, and no competition all at once. And being honest, that doesn't exist. What exists is trade-offs. The smartest investors understand this. They find rare windows where trade-offs tip in their favor, and then they move fast. Let me show you exactly what I mean. Remember 2021? Mortgage rates hit a historic low, 2%, and everyone said it was perfect. Cheap borrowing, low payments, what else could go wrong? Here's what actually happened. Rates dropped and every buyer could suddenly afford more. A family budgeting $250,000 at 5% could now stretch to $320,000 at 2%. Same monthly payments, more buying power. Which sounds great, doesn't it? But here's what people miss. When rates drop and buying feels safer, more investors come out of the woodwork. The seasoned operators are investing in any market, but low rates, they bring in the amateurs. And everyone who was sitting on the sideline suddenly thinks now's the time to buy. And that puts more competition into the system. Multiply that across billions of buyers and bidding wars erupted. Properties sold 10, 15 and 20% over asking. And people just binned off surveys, waived conditions and panic boards everywhere. Cheap money created the most expensive buying conditions in a decade. The upside is cheaper borrowing. The downside is you massively overpay, and that overpayment is locked in forever. Rates can change, but purchase price doesn't. And remember this, low rates don't create a buyer's market. They create a seller's market disguised as opportunity. What about a true buyer's market? More stock, less competition, desperate sellers. Surely that's perfect. Well, in 2009, prices had fallen 18.6% from the peak. There was more choice than anyone had seen in years. Sellers were begging. You could negotiate 15, even 20% off asking. Every metric said buyer's market. So why wasn't everyone buying? Because buyer's markets don't happen in a vacuum. They normally happen during fear. 2009 came with bank collapses, recession, unemployment spiking, headlines screaming disaster. Nobody felt confident. Everyone waited for the bottom. But the bottom, it came and went, and most people missed it. For example, London grew 57% from 2009 to 2016. People who bought in 2009 look like geniuses now, but at the time, they were probably terrified. The upside in a buyer's market is choice, value, and negotiating power. The downside is it comes wrapped up in fear. The perfect buying opportunity never feels perfect. That's the yin and the yang. What about the opposite? Seller's market. Prices are rising, demand strong, capital growth is happening. If you buy into the momentum and just ride the wave, that's the smart thing, right? Well, in late 2022, prices were still climbing and momentum looked strong. Then September 22 hit. The Liz Truss budget, which rocked the whole of the UK. Rates spiked from 2% to 6%, virtually overnight. And people who bought at the peak with a 2% assumption, they faced payments 50 to 60% higher on a remortgage. And some couldn't afford it, forced to sell and created negative equity for a lot of people. The upside here is growth while you hold. The downside is you buy at the top of the market. And the key thing to remember is the top of the market doesn't announce itself. Sellers markets feel like confidence, but that confidence is often a danger sign. Remember, there's no headline saying this is the top of the market. What if you just forget about time and growth and you focus on cash flow? The Northeast got 7.9% yield. London 4.5% yield. Why the gap? Well, yield comes from price. Lower price means higher percentage yields, but low prices often mean slower capital appreciation. Regions delivering 7 to 8% cash flow don't typically deliver 50% capital growth over a decade. Regions with massive historic growth, they've normally got 4 to 5% yields because they barely cover costs. So the upside here is strong monthly cash flow. The downside is you often get slower growth. Remember, cash flow or growth, you need to pick one. Getting both at scale is rare. You need to know which one's your number one and which one's your number two. You can't sit on two chairs at once. Now this is where it gets interesting, because we're in the largest landlord exodus in UK history. 93,000 landlords exited in 2025. 31% of the remaining landlords plan to reduce their portfolios, and 16% consider selling everything within 2 years. Less competition, more motivated sellers, surely that's perfect. But here's the yin and the yang. If amateur landlords exit, rental stock shrinks. 284,000 rental properties available. This is a historic low, down 18% year on year. Fewer rentals means higher rents. Good. But it also means tighter margin and more regulation. The Renters' Rights Act hits in May 2026, and governments can't stop amateurs leaving, so they squeeze professionals who stay. The upside here is less competition and more motivated sellers. The downside is there's more regulatory pressure and political spotlight. The landlord exodus creates opportunity, but with strings attached. There's always strings attached. So every market has a trade-off, and the perfect market doesn't exist. So why am I saying 2026 comes close? Well, here's what's different. Multiple positive conditions are stacking in our favor, without the usual offsetting negatives. Number one is it's a buyer's market confirmed. Rightmove has said it explicitly. 7-year high in stock. More choice, more negotiating power. Number two is affordability is improving, and it's been improving for 4 years straight. Wages are outpacing prices, and the ratio fell from 9.5 to 8.2. Number three is modest price growth. Forecasts state 1.5 to 4%. So it's not super high so you're overpaying, and it's not falling so you're losing equity. Number four is regional outperformance. The Northwest has grown 27.6% over the last 5 years, whereas London's 17%. And you can still find 6 to 7% yields and strong growth, which is rare. Number five is the landlord exodus, creating deals, motivated sellers, and below market opportunities. And number six is the structural supply crisis. Now this is something I talk a lot about on this channel, and it's the core fundamental reason of UK property investing and why I'm completely bullish on it. The government said they were going to build 1.5 million homes by 2029. Savills forecasts 840,000 will be built, so they'll miss it by 42%. That gap is a tailwind for years. Is 2026 perfect? No. Rates are still around 6%. Regulation is increasing and there is uncertainty, but that's the trade-offs. For the first time in 15 years, I think they tip in our favor. And this is what makes this window different. The underlying fundamentals of UK property haven't changed, and they're not going to change. Population growth, supply shortage, and rental demand. What has changed is the competitive landscape, and this is where the opportunity lies. And that's the framework. 5 market types and 5 trade-offs, and why 2026 stacks differently. If this helps, send it to someone who's on the fence about property investing, because they need to see it. And if you want to explore working together, there's an investor waitlist in the description below. But an important question I hear you ask, where should I deploy money in 2026? And that's a different question. And I've made a video breakdown on specific regions, postcodes, and yields. So watch that next, and I'll see you guys in the next video.